Well, let's head to Zimbabwe now, where the move by the country's central bank to raise lending rates from 40 to 60% could have some unintended consequences on productive sectors. That's according to some market analysts. Now, last week, the country's apex bank raised lending rates to quell speculative borrowing, its latest effort to contain inflation, causing exchange rate volatility.
12 months, the local market has witnessed a gradual and what some have called unsustainable growth in liquidity. Monetary authorities believe that that is being driven by speculative borrowing and that it is exerting inflationary pressure and creating exchange rate volatility. To give you an example of how they think this is happening, they believe some people are going to their banks, getting overdraft and loan facilities at very cheap rates, using that money to buy foreign currency and holding it for speculative purposes. After a couple of months, they then sell that money on the black market, and given the movement in rates on that parallel market, are able to repay their loan plus the interest and walk away with a profit. It's for that reason that they've now hiked lending rates from 40 to 60%. The logic being that if it is costlier to borrow, it will discourage that unnecessary borrowing. Earlier, I spoke to a financial and economic analyst who does not necessarily believe that speculative borrowing is the only reason why we are seeing this inflationary pressure and market volatility.
They believe that there was too much money in the economy, but that money is not really coming from speculative borrowing. I think it's coming from misalignment in terms of government payments from government. We've got a very few companies that are in the infrastructure sector, and those companies, they woke up with about 33% of the national budget, which was going to be spent on infrastructure. So when they get paid, they need to find a safe home for that money, and I think that was the reason why we saw the depreciation of the local currency that has caused or resulted in the RBZ trying to make these moves. However, it also has unintended consequences, because the productive sector, who are actually borrowing for production, they are also going to be paying these high interest rates. And remember that if you are going to pay above 70 to 100%, it means that also the cost of your products will also have to go up, and it might end up causing inflation as well.
Now, apart from clamping down on the speculative borrowing, the central bank has also said that it hopes that this latest measure of hiking the rates will result in real positive interest rates to depositors, which will encourage savings, crucial for economic growth and investment in key projects such as infrastructure. Farai Mwakutuya, CGTN, Harare, Zimbabwe.